Hi, everybody, and welcome to the Middle Class Investor. This is Seth Martin. It is Tuesday, about 10:40, February 13th. And sorry about the lack of videos this weekend. I was traveling a little bit and just couldn't get around to it. Normally, I would wait until the following weekend, but we had such a volatile week last week. I wanted to put a video together and talk about that a little bit in case. Um, you're wringing your hands or there's some anxiety about what we saw last week. So um, what we've got here on the chart, let me back up and just show the whole thing. So here's the 2009 low after the financial crisis. Now, isn't this interesting? I mean, look how this was such a horrific crisis, but look at that. That's hardly, I mean, relative to where we've gone, this little fall down looks like nothing. And that's kind of the way the market is over time. Put on log scale, it doesn't look as nothing on log scale, but um, that's what happens is the market percentage wise it grows about the same, but relative to the past that's why when you look back, if you look back at like the Great Depression or the crash. Um, it doesn't look like that big a deal. I barely got it on the chart over here. I'll zoom in, and this is the great crash right here. I mean, it looks like nothing, but that's just the nature of the market. So don't be fooled by that. When you're actually in the fight, so to speak, it's very traumatic and scary. So here we are, way up here. We've had this is an intermediate rise of trend. The bigger in Elliott wave terms is this cycle degree trend started in 1932, way back here, and you had wave one. This was basically all of wave three. Of course, there was a wave three is made up of a 1, 2, 3, 4, 5. So and then we've had 2000. We had the top of wave three, and then we've had this pullback ever since 2000 that's manifested itself in a higher market, but in terms of standard of living has cost most Americans a great deal. And then you can see this last intermediate move up into here. So that's what we're dealing with. Let me go back to 5-year. Let's zoom in on so the market is live right now. So you're looking at this right here is this current week as of Tuesday. So this was last week, and you can see we had a pretty volatile week before, and then we continued down even further last week, and then you can see here we rallied right here. We rallied up, and then the market gapped up and has continued to run up a little bit. So when I say a little bit, I mean relative to these other moves, but actually the numbers have been quite high. I mean, if you look at the range, the week before last, the range was 110 points on the S&P 500, and then last week the range was 230 points from high to low. So those are pretty big ranges. So far this week, the range has only been about 50. So volatility, we should expect to see volatility drop down a little bit. Let's just look at that. Let's look at CBO volatility. You can see it spiked here. Let me get this. Let me make a. I want to get this. I've got something on here, and I don't know what it is, but I need to get it off. So let me go studies, edit studies. Sorry about this. I should have done this before. Moving average. Maybe it's this right here. Yeah, I got rid of it. So no, it didn't either. Gosh, I don't know what that is. It's something on the lower. the lower margin here, it's a Bollinger Band, I think. Oh, that's what it is. It's a Bollinger Band. Let me take that Bollinger Band off. Edit studies, Bollinger Band. That's skewing our data. There we go. That looks a little bit better. So you can see here the we talked about this a couple weeks ago that once volatility breaks out, I mean, it can really move. And so what volatility is, it really has to do with the options market. And so what happens is when the market really starts to move great distances like this, the options market tends to increase the price of options, really to discourage people from buying long options and trying to take advantage of large moves in the market. So that's what this volatility is about. You can trade the S&P 500 from high to low, and you can trade it with stock. The problem, the reason most people don't do that is because anytime you buy stock, there's a settlement period, and it's usually like 2 to 3 days. So on options, you don't have a settlement period. You can literally buy an option here long, sell it here, and then sell short, like a put, and then buy back the put, and then you can there's no settlement period. So so the options market allows you to day trade, take advantage of these intraday moves and stuff like that, just like futures. But the way they manage the risk is they make the options more expensive than they otherwise would be in a real quiet period down here. So if you were gonna try to short the market, let's say with options, you would have needed to be a buyer of options down here somewhere, because what happens is let's say normally you buy an option down here, say for 50 cents. Well, that exact same option, if you waited until volatility was up here, might cost you $1.50. Well, that means that your cost basis is higher. So in order to make the same rate of return, it has to move further. So this is the way they deal with that risk. But volatility, what it really tells you is it's kind of a fear gauge. So fear got pretty substantial here. I mean, volatility got all the way up to 50. What is that? 52, 50.3. So that's pretty high from down here at what was this before it took off. The low here was 11. So it went from 11 to 50 in just a couple of weeks. That's pretty amazing. So, but that's typical when you get a big sell-off like that. You can have real high volatility swings. Now, is that what's causing the market to sell off? I mean, there's a lot of talk about, oh well, this is program trading and that's what's causing the market to sell off. No, this kinds of effects have been studied by Prechter and his group many times, and there's no evidence of it. You simply have people out there trying to justify or rationalize their position for the market. And so it makes them feel better psychologically that, well, this is not traders, this is not individuals doing this. This is program trading causing this, and we need to have some regulation, or we need to stop this program trading somehow. Well, what they forget to tell you, or what they neglect to mention, is that program trading was there before. So this is all program trading. I mean, program trading is part of the market now. So this whole rise from down here from the 2009 low, this program trading was involved all along the way. I mean, program trading didn't just happen last week. It's been going on for years. So it's not the cause of the sell-off. The cause of the sell-off is just you're starting to have a change in social mood, and that tends to change the trend. And the market is very sensitive to mood. I mean, we're very collectively, our mood shows up in the market. This is what Proctor shows in his research. It's very hard to believe, but the more you look at it, the more you just can't refute it. It's impossible. So anyway, so let's zoom in, because I want to bring up something here that is important when you're talking about, okay, what's the next move? What can we expect? What's likely? So there's a couple of things here that are worth mentioning. I'm going to zoom in real quick and I'm going to highlight them. So there's a gap right here, okay, in the market, and there's another small gap right here. So if I can highlight that one as well. I'm not sure I can. It's so small. There we go. Yeah. Whoops. I'm going to do like that. There we go. Got it. Clicked finally. So one of the things about the market is gaps usually get filled. Now, which is kind of got me a little confused, because that means the market would need to retrace all the way to here, this zone right here, before we, assuming this is a trend change, okay, which it appears to be, the market would need to travel all the way back up here to close these gaps, not make a new high, and then sell off. My personal experience is when the market retraces that much of a move, it ends up just being, so let's see how much of a retrace that would be. You know, to get all the way to here, you're talking about an 80% retrace. Now the rules say that you could trace 100% of this and still have a wave 3. It's just very, very, very rare. Now, does that mean it's not going to happen? No. It's just very, very, very rare. And so I don't know if that means these gaps are going to stay on the chart until 2021 or what, but it's definitely, I don't like to see stuff like this. Like if I'm trying to short the market right here, you know, I want to buy some puts, or I want to short some stock, or buy some inverse fund or something like that, I don't like to see these gaps up here. I don't want to see a gap right there and a gap right there. I'd rather see, you know, overlap between these trading days here. So that's one commentary. Now the next thing, you know, is when we do have a correction, we generally correct in an ABC type manner. So we might have something that looks a little like this, and maybe corrects up here to the 2740 area, and then we get a wave 3. But it does appear that the trend, you know, this trend is broken, and because this was a wave 5 of a wave 5 of a wave 5 of a wave 5 of a wave 5, when this trend breaks, it means that's a top. So but we need to wait for the evidence. So really, if you're still in the market, you can wait till this corrects a little higher, and then what we should see, a lot of times what you'll see before the market rolls over is you'll get, let's say you get a down and then an up, and then right in here maybe you'll get some candles that look like this, kind of deal, and then you'll start getting really short body candles with extensions on either side of them, like this. They're called dojis, where there's a lot of range, but the open and close are pretty close together. Maybe even like just almost like a line like this, and then a line that maybe get up real high like this, and then turn around, sells off, and then you get like a bar like this. And if you get something like this is this series of bars here, especially these last three, this bar, this one, and this one, starts to tell you that this trend is starting to roll over. So if you start getting something like this, you might want to say, let me step aside and let's see if this is going to turn into the big bear that we've been talking about. So hopefully hopefully that's clear to everybody and it's easy to understand, because that's super important when you're trying to decide what to do. You need to be looking at, you need to look for the correction, and then you need to start looking for certain candles that tell you that part of that part of the trend is getting very, very tired. Okay. Okay. Let's see. Let's look at let's look at treasuries. Let's look at the 10-year. The 10-year continues to go higher. Been talking about that for years now. And I mean, you can just see we talked about that might pull back to this trend line and then take off. But as you can see, it didn't even pull back that far, but it did take off. So I would expect this to this is probably this is the big wave 1, the big wave 2. These are smaller degrees, wave 1, 2, and now 3. At some point you're going to get some pullback, and then a rise, and then another pullback, and then another big rise. So one of the things I've got here on the chart is I've got a little Fibonacci, and so I've taken the high and pulled it back to the low. And once you break out, well, there's actually a couple different ways to do it, and I just noticed that I did it the less conservative way. I think I want to show you the more conservative way. So if you come here to the high and you pull back to the previous low, and then we zoom out a little bit so we can see how far that goes. So you can see that 377 area is right around our little block here, our little decision point area. So I would expect this move to continue to at least this 4.2, 4.3 area before we get any kind of pullback. So as these rates start to move up higher and higher, you're going to hear more and more about this. It's going to be very, very damaging to people that are holding bonds, high yield bonds, things like that, municipal bonds. Now, if they're actually holding bonds, you can hold a bond until maturity and get your money back. But if you're in bond funds, which is what most people have in their 401ks and IRAs, bond funds are losing money. They're losing a lot of money. By the time you get here, you're talking about this kind of move in interest rates can be like maybe a 20 to 25% loss in bonds. So be very, very careful. Continue to say that here. It's just, the problem with bonds is most people think they're safe. Well, they are, for the most part, especially if you buy the bonds themselves. But when you're in a bond fund in a rising interest rate environment, it's no different than just being in a bear market for stocks. You're owning something that's just continuing to lose value day in and day out. So if we look at the 13-week Treasury, people are already starting to talk about the Fed's getting behind on this. They didn't raise rates here recently, even though this is going up. And what I think is interesting is they're talking, people are talking about, well, why are these interest rates going up? Oh, well, it's signaling inflation. And I think actually people are wrong about that. I think what you're going to see is you're going to see deflation. The amount of debt that we have and the stress that causes on individuals and the economy as a whole, you add up all that stress with all the individuals, and then that stress, tends to show up as a collective kind of measurement in terms of defaults and things like that. This is why the interest rate's going up, not because of inflation. We're going to actually have deflation, and it's going to cause people to start defaulting on these debts. And this is a particularly difficult place to be in because the savings rate has been so low for so long. The market is basically telling us that we need savings, and now it's going to start paying up for savings because we need capital investment. We haven't had a real increase in standard of living. You got these crazy, Elon Musk launched a Tesla into outer space. For what purpose? so you have crazy stuff like that going on. It's just a waste. It's a waste of resources, and and a lot of that's been fueled by these low interest rates. It allows people to live beyond their means and waste resources that they otherwise would not waste if the interest rates were at a more normal level. And sends incorrect signals to market participants about what to do with their money, how to borrow money, what to invest it in, all kinds of things. So anyway, let's look at some of these other countries. We've been looking at Germany. You can see Germany sold off. It is interesting though that it just went right up to this. It had one close above the. And this box, by the way, is just very arbitrary. I mean, I just draw it based off the major swing here. But isn't it interesting? And there's, I mean, it could have been wrong too, but this is what tends to happen. The market goes up to these areas just beyond the swing, and it tends to reverse. So, isn't it interesting that it did that right here in this little zone that we had marked? Japan. Now Japan went a little higher. We marked another swing off this yellow zone a little further back. Oh, gosh, quite a bit further back actually, off of this swing here. So this was the, if you notice here, this market went up and then it came into a low. This swing resulted in a low. So this is an important swing here. So I mean, we could have made the box, we could have made it a little taller, like so, and actually capture that. But I just, again, it's arbitrary, so it doesn't really matter. It's just a place to where you might expect some selling to take place in a bull market. Let's look at United Kingdom. Again, this is a major swing. This was a swing into the high. So this is the major swing you want to focus on. And there again, the market ran up into that box and reversed sharply, probably ending this trend. Notice the gap here. So that gap will probably be filled. Anyway, it's just really what you need to look for is, like I said earlier, is look for this to correct, and then look for on a daily chart, not on a weekly, but on a daily. Start looking for some dojis, and then the market rolling over, and that's when you want to take action. All right, let's switch over and look at gold and silver and stuff like that. Gold doesn't look like it's going to make it to our box there. Looks like it's going to fall short. As you can see here, it's kind of just made a new high and then starting to roll over. Probably will come all the way down into this area here, or lower, maybe this area here. But certainly if you wanted to short gold, it looks like a pretty good trade down into this area, at least. Silver looks like it might be a more complicated structure, but eventually they'll result in a similar result. But it looks like maybe there's some sort of triangle or something here with silver, and so maybe we had this move down, and then we've got this kind of an A, B, C, D, E, and then we're going to continue down here. So maybe silver comes down, down into this area. There's not as much room here to trade silver as there is on gold, so I think I would tend to, if I was going to trade, I would trade the gold short rather than the silver short, because there's just more bang for the buck, more reward to risk. Here's the euro. The euro, this has been a challenge for me personally. I haven't been as accurate on the euro as I would like to be. Sorry about the jumping around here. I'm trying to get it lined up just right. So, I mean, the euro, this almost looks like a little wave 4 here. So this could have corrected, and it ends up, kind of meandering its way up here to a new high and then down. But certainly you wouldn't want to be long the euro. I mean, the fact is, whether this yellow box needs to be here or up here, we're in a place where, you know, you would expect the euro to reverse and start going the other direction, which means the dollar is likely to reverse and start going the other direction. See if I have the dollar on here. And I can type it in real quick. Dollar DXY. So, you know, the dollar's been selling off hard. You can see, and you can almost see like a little, let me kind of zoom in and draw it. You can kind of see, you know, a 5-wave move here. You can kind of see the 1, 2, this is all 3, and this is 4, and this is 5. So what do we know that happens after 5-wave move? Well, we know that you typically revisit the 4th wave low. So that means the dollar should, over the next 6 months or a year, make its way up here. Maybe not that long, maybe only 3 months. Sometimes this 4th wave low move can be very, very fast. So just be on the lookout for that. But you can clearly see 5 waves down here. We're going to get some sort of retracement to here. Probably, maybe this is an A, and then a B, and then a C, and then you know, maybe the dollar goes lower at some point. But the dollar is going to go much higher before it goes lower. The markets don't go straight down. We know that, and so the dollar, you wouldn't expect the dollar to do that either. U.S. dollar CAD, I still think there's a good trade here in the U.S. dollar CAD. You can see now I've been talking about this for, I don't know, a while now, but you can see we made an important low. We made this rise off the low. It could be that, you know, it's not done correcting. In other words, it could end up looking like something like this, where it corrects like so to here, and then takes off. But we do have, you know, we have a low, and then we have a higher low. So this right in this area would have been a legitimate entry for the U.S. dollar CAD long. But if you missed it, and you know, if you're long in the U.S. dollar CAD, you want to kind of really focus in on this trend line area and see what the market does there. If it breaks out, great. But if it could also just, this line could actually just repel it, and it could come back down here. So if you're not long U.S. dollar CAD, you probably don't want to go long right now. But if you are, you want to really focus in on what's happening around this trend line, because you could end up giving back your gains and then some. If you're not in the U.S. dollar CAD, you might want to wait and see what it does here. It could break out, but then when it does break out, a lot of times it'll retest this trend line, and then you want to look for an area to go long, say there. So those are the two options that you would want to focus on around the U.S. dollar CAD. The British pound, I mean, it just never did come back. It just took off and went. So I don't know if that's, I mean, you don't want to chase anything for sure. So I would say I wouldn't even look at this unless it came back to this 1.27 area. I think it's just too risky, taking on too much risk. Unless you just want to do like a bounce trade, like a flag trade. And I'll just, on this one here on oil, I'll explain what a flag trade is. So a flag trade is just you've identified the trend. In this case, on oil, the trend, let's say, is up. Okay, just right here. So since the trend is up, what you're looking for is a pullback. So what you want to do is you want to kind of just put some lines around the majority of the price action here. And then, you know, you can see it broke out and retested. So it broke out, retested, and then you can enter here. Or you can enter here on the flag and just, you know, live with this wiggle, or you can wait for the, sometimes it doesn't come back. Sometimes it just takes off. But another good entry is here. So you can enter on the breakout of the flag. So this is the flag. And the way this works is you measure this distance, and this is the flag at half staff. So then you would add this distance to the breakout area of the flag. That's kind of how it works. And then you would be in this whole time right here. And you just would follow the trend line, you know, just draw a trend line under it. Once it breaks, you would say, okay, I'm out. I've got some sort of Microsoft account problem. That sounds scary. Anyway, that's a flag. So you can always trade a flag as long as you know the direction of the trend, and you just want to just get out when the trend is broken. In this case, it was broken here on this candle. You can plainly see that this trend was broken right here, right about there. So you would just have a stop set down here somewhere that says I'm out. Okay, and you would have captured all these gains. Your gain would have been from here to there, which is pretty good because your stop would have been below here. So your reward, your risk would have been this distance here, and your reward is this distance from here to here. So clearly that looks like more than three times, which is always a good target on reward to risk. All right, is there anything else? I want to switch over real quick to the Elliott Wave financial forecast and just kind of show you what they're charting. So you can see 5 waves here. You can see 1, 2, 3, 4, 5 down. So this is, I don't know, minor degree. It's just an intermediate degree trend line. So the intermediate degree trend line was broken, which usually means that's the end of the trend. And you can see this was a minor degree down, wave 1. So we're going to have a wave 2, minor degree wave 2 up. And what they're saying is that A is finished or will be soon. And once A is finished, you'll have a B down and then a C up. And they're saying C could go all the way to the very top and retrace all of 1. But it should at least go to this 25,500 area and maybe a little bit beyond. So this is a previous 4th wave. This is a previous 4th wave. These are areas where the market generally goes to before it turns again. So look for a key area would be that 25,500 to say 26,000. Those are the key reversal areas. But again, we still have these gaps. We have a gap here. We have a small gap here. Those gaps can be filled first, and then the market can reverse. So, which is going to be very confusing. I mean, people are going to be really bullish. If the market gets all the way back up here, people are going to go, well, that was nothing. They're just going to write this whole fear experience off, and they're going to say, we're on to a new bull market. But be careful, because if those gaps fill, the market could then start rolling over, and this next move could be a doozy. So it'll make the first one look like a picnic. All right. Well, that is it for this week, everybody. Thanks for coming in. Be sure to share the program with friends and family. And I think if you do, I think people will get something out of it. I was just looking to see if there's anything here I want to share with you. Well, real quick, I can share, the software that I use. You can also see a 5-wave move. I think I need to put it. For some reason, 90 minutes still leaves me a little wiggle here, so I think I got to put in like 100 minutes. Yeah, there you go. So now you can see, if I click over here, if I say Elliott Wave Intermediate, click here, you can see it counts off 5 waves, 1, 2, 3, 4, 5, just like Elliott Wave did. And the first area that you want to see a retrace to, or that's likely to see a retrace to, is this decision point here off the previous 4th wave low. And like I said, there's gaps up here in these areas, like right here, and there's another one right here. So those areas this could retrace quite a bit. So, all right, everybody, that is it for the week. Thank you for coming in. Share the show. You can follow me on Middle Class at Investor Class on Twitter, and comment in the comment section on YouTube, and we can have a conversation if you want. All right, thanks a lot. Take care. Bye.